A wonderful morning to everyone. This is Magdalene from Itus Capital, and I'm glad to welcome you all to Itus Capital's 1Q Investor Call 2023. At this time, I'd like to thank all the participants for taking the time out on a Saturday morning to be a part of this call. All the participants will be in listen-only mode, and after a presentation by our founder and fund manager, Naveen Chandramohan, we will have the Q&A session. Today, Naveen would walk us through our portfolio performance in the last quarter and give us an update. Over to you, Naveen.
Thank you, Magdalene. And again, I take this opportunity to thank everyone who's taken time out to attend the call. Like Magdalene mentioned, we look to cover our portfolio performance, some level of attribution analysis of our portfolio. We'll also look at covering our latest position that we've added in the portfolio, why we've done it and what our expectation is, and then move on to our overall view on risk in markets. Finally, we'll take some time and dedicate both stock-specific or portfolio-level questions from anyone who has any specific questions that needs to get addressed. So, like we always do, just for people who could not attend the previous call, which was held in Deck 22, this is how we left off the call. We spoke about our portfolio fundamentals being at its strongest, measured in the form of the cash flows that the portfolios are throwing up, the pricing power of the businesses that we own, which is measured in the form of gross margins of our portfolio, as well as those cash flows which are getting reinvested, where is it getting reinvested? And measured in the form of return of incremental capital. So these are the three metrics that we use from a quantitative perspective to measure the health of our portfolio at any point of time. Valuation and liquidity, though, was not very favorable back then. It's one of the reasons we reiterated that there was a lot of cash in some of the new portfolios that we had held. And we'd also made a few capital calls to ask clients if they had the ability to add. That was a great time to look at adding because we felt that the volatility should be high. Now, for us at that time, risk reward was to the downside. When I say risk reward, I'm not talking about market going down or market going up. I'm just talking about things from a probabilistic perspective. And which is why we said, if that materializes, we will be aggressive in deploying capital. And back then, we made the statement that 2023 should see volatility. And we would want to use that volatility to deploy capital into bottom-up opportunities. So with that as the context, we'll go on to today's call. Right? Like I mentioned, we'll cover our performance. We'll review the quality of the portfolio very quickly. We'll review our recent buy, spend some time on it. We'll also talk about why we maintain cash. And when we maintain cash, how should our investors even think about it? And what is this concept of a capital call that we do from time to time? Why we are underweight IT currently? We have been underweight for a while. If you remember, for people who joined our call, we received some slack, but we sold Infosys, I think roughly around 5 to 6 months back. And that was one of our largest weights for many of our investors because we'd held it for a good part of 3.5, 4 years. So we completely exited that 6, 7 months back. And why are we overweight auto ancillaries today with a manufacturing bias towards it? Why I will continue to be cautious US this cycle. When I say cycle, I'm talking about a 3-year horizon, I'm not talking about next month, next quarter, or next year. And forward expectations is something that I would want to leave every investor with. Up to our performance, we've CAGR or cumulatively generated 185% for investors, net of fees and expenses since inception. We maintained since day one that we run a multi-cap fund. Funnily enough, today, SEBI has come out with a circular saying that PMS funds should benchmark to one of 3 indices only. So they are basically forcing every PMS fund in the country to choose one of the three funds. This has caused a lot of headlines, both in newspapers, PMS fund managers being angry, but I'm happy to say it's not affected us at all. Because I have maintained since day one of starting this fund that Nifty 50 will be the best performing index in our country, not just today. If you take the past and measure it in 5-year periods, and I'm confident if you take the future and measure it also, it will continue to be the best and the most consistent index. So nothing changes as far as we are concerned. And this is how we will continue to do things. Once you are invested in the fund, roughly would be worth 2.85 today, versus approximately 2.1 in the Nifty. So we've beaten the Nifty by roughly around 5.5+% over the last 6+ years of inception of the fund. While all that looks rosy, right, it's important to put certain things in context for the investors in Itus. So I want to spend some time to even explain what does a benchmark even mean to us, right? Obviously, I need to benchmark ourselves for you to explain what we are doing and are we doing a decent enough job of managing your money. But more importantly, you need to understand what does a benchmark even mean as far as the way we manage money. So I'm just breaking down Nifty for you and Itus portfolio for you, right? And let's just go into the constituents. Nifty has 50 stocks. We have roughly around 22 to 23 stocks. The financial exposure in Nifty is 37%. We have it at 10%. The auto exposure in Nifty is 6.5%. That's our heaviest weight today, in the form of ancillaries at 18%. The highest weight of Nifty is financials. The highest weight of Itus portfolio is manufacturing. The weight of PSUs is 7.5%. Why did I bring that in? Because in 2022, that was the best performing sector. We had, and we will continue to have zero exposure in PSUs. So what am I trying to explain to you? I want to leave you with 3 important points. We are active managers, and we are not looking at benchmarking or hugging the index as far as constructing portfolios is concerned. What does that mean? Most portfolios, when constructed, many of them start top down. What that means is they say, okay, IT in Nifty is 12%. So when I'm underweight IT, I'll take it to 6%. That's underweight for many. For me, when I'm underweight, I'm 0, right? So for me, it's when I'm underweight, I don't like the business, or rather, I don't like the valuation, which means I'm not looking to hug some index to outperform every year or every quarter or every month. That's not what we do. Because of these kind of deviations, our benchmark and our return will deviate, both positively and negatively. I cannot come and make a statement to you that I will always deviate positively. Life doesn't work that way, right? There will be negative deviations also, and I'll tell you how to think about those negative deviations. How do I measure ourselves internally? I measure it over 3-year horizons. And that is why I always tell any investor who speaks to us, on day one, when you give us capital, at least do it for 3 years. And finally, I want to maintain this point that we are not buy and hold investors. We have seen churn, we will continue to see churn, and there is a reason for that churn, and I'll address that later as well. So why do I ask for 3 years? Because that's how we think about fundamentally investing. And now, how do I measure ourselves on 3 years, right? So what I'm saying is, the thing about a PMS is a model portfolio is suboptimal for you as investors, because I cannot tell you that valuations are important for me, but I'll run a model portfolio. These are 2 conflicting statements that you need to understand. So when I tell you that valuations are important for me, it is imperative that I don't run a model portfolio. What does that mean? That different investors coming in at different points of time might see marginally different returns, because we are constructing portfolios which are customized for you. So what I need to do is, across time, measure how have 3-year returns been for our investors who've started at different points of time. So the chart here shows the line in blue at various start points that the investors may have come in. Why does this end in March 20? Because I'm talking about 3-year returns. So next month when we do this, we'll talk about it from ending April 20 and so on and so forth. On a 3-year rolling basis, we measure ourselves saying, have we done a decent job of outperforming Nifty? And the the line in orange measures the Nifty returns. This is how we are measuring ourselves. And there is a dichotomy because the investors are measuring us on a quarterly or a half yearly or a yearly basis. I am measuring our performance on a 3-year basis. And it's important for me to keep communicating this, right? I know it's not easy, but that's my job. And if I don't do it well, then I'm to be blamed, not you. And I understand that. And that's why we write. The second thing that we also do is we ask for capital calls. Why do we do that? Because I am telling you at that point of time, I see opportunities. Now, sometimes investors acknowledge, sometimes they may not. That's all. That will always be your discretion. But it's important for us to write to you and communicate that. And doing those capital calls, if done at the right time, is an additional source of alpha. I will also aim to return money over time, both partially depending on the opportunity set that we see. So if a certain pool of capital has generated the return that I expect, and I don't find adequate opportunities, I might choose to return capital. And how? I'll explain the process to you over time as well. With this as the context, so we've just gone through the performance of the portfolio since inception. What does a benchmark mean to us? How do we think about risk and how do we construct portfolios? Now I move on to the health of our actual portfolio. Like I said, cash flow growth, return on incremental capital, these are things that are actually calculated. What is easy to do for anyone is to actually look at our revenue growth and our PAT growth. And I always say, so this is as of December 2022 quarter, which is effectively the third quarter financial year that's just gone by. March quarter is just starting. As you can see, a few companies have started reporting earnings like TCS and Infosys. And over the next 1.5 months, we'll finish the quarterly earnings for the entire set of companies in India. And we will speak about it in due course. But this is as of December. Obviously, the QOQ is not a great metric to look at it because a lot of the companies have quarterly seasonality. A lot of the companies have cyclicality quarterly. So we always look at it on a year-on-year basis, but the way we do year-on-year is different from the way the market does year-on-year. Market just compares this quarter versus last quarter last year. That's not what we do. We basically take the rolling 4 quarters versus the rolling 4 quarters last year. And that will remove some amount of seasonality that we don't want to see because you can't measure companies on a quarterly basis. What we want is we want growth. We want stability in management, and we want management to reinvest at the right places, not go into some kind of unrelated diversification, which generally is not something we are comfortable with. Third thing that we want is the fact that companies have the ability to maintain their pricing power as they scale. And very few companies in our country have that, which is what I measure through gross margins. So many of the companies in a certain cycle have transfer power pricing, but most of them, when raw material prices increases or they have some kind of pressure, like what you're seeing in IT today, their margins will drop. And it's important to understand what kind of companies in what kind of cycle have those gross margin or pricing power. So when we measure gross margin, we ideally like companies that have the ability to at least maintain their margins. If they can expand their margins, it becomes even better. So with this as the background, with that saying that the portfolio quality is in reasonably healthy and good shape, we now want to talk about our latest addition in the portfolio. As many of you are aware who've been with us for a while, somewhere late last year is when we completely exited ICICI Bank, and that reduced our financial exposure in the portfolio. And in this quarter, we added IndusInd Bank into our portfolio across portfolios wherever there was cash. And in those portfolios where capital calls gave us adequate and increased incremental cash. So what was the thought process behind adding IndusInd Bank? And what do us as a team expect from here is what I want to spend some time covering. So IndusInd Bank over the last 3 years has been taking a series of initiatives in order to transform the bank. What do I mean by transformation? Pre-2019, right, is roughly, so if you look at the performance of the bank between 2010 and 17, it had a phenomenal performance from, I'm not talking about stock price. Whenever I talk about performance, I talk about fundamentals. Stock price is a consequence of fundamentals. So when I say performance, I'm talking about return on assets, I'm talking about return on equity, I'm talking about loan growth. These are the fundamentals that we look for. I'm talking about net interest margin, etc. However, that entire growth was funded on the back of wholesale banking, which effectively means when corporates go through pressure, the entire thing will fall apart. Right? You saw that with Yes Bank. You saw that partially with RBL, though it's not a like-for-like case. You also saw that with IndusInd to an extent. Over the last 3 years, though, the bank has taken a conscious effort to move from a wholesale funded franchise to a retail funded franchise. How can you measure the same things that I say? You can look at the CASA growth. So the CASA for this bank was at around 28%. Today it's at 41%, right? And the ROA was at 1.8% at the peak. And that's when it was trading at a rough price to book multiple of 4.2. PE, which is what many investors look at, is not a good metric to measure financials because they are levered entities. And hence, a price to book multiple is a better way of doing the same. Now, what drove this transition? There were a few things that was happening at the top. The current CEO, he took hold of the bank roughly 3 years back, Suman Katpalia. He came from a retail banking franchise in Greendays. And around that, they added a lot of branches. They added a lot of retail-focused approach, as a result of which the wholesale portfolio became a lot more granular. And that's what you want in a bank. You don't want concentration. And it's perverse, right? Because most PMSs in our country are sold on the fact of, I love concentration and hence I can make greater returns. It's absolutely not true. Okay, concentration is a double-edged sword. You get it wrong, you get killed on the downside. So it's really important that concentration is done correct when growth visibility is there. So wholesale portfolio was what killed IndusInd Bank in the form of concentration, and that is what they're making it a lot more granular with a lower ticket size. So that transition has been happening in the last 3 years. So what do we see as an opportunity today? Why now? Right? The vehicle finance disbursement. Now, vehicle finance is effectively a very, very cyclical part of the portfolio because, as you can imagine, auto is extremely cyclical, right? Now, 26% of the loan book of IndusInd Bank was vehicle finance, and that went through a cyclical downturn, as many of you are aware. And that hurt the advances. For the first time this year, as auto is improving, you've seen roughly almost a 22% growth in the vehicle finance book. Lower concentration makes the loan book a lot more granular. MFI, the credit cycle is actually picking up. Bharat Financial is one of the best in class in terms of MFI in the country, which was acquired by IndusInd Bank in the mid-2015s. And more importantly, promoters actually converted their warrants, which means the tier 1 ratio of the bank is at greater than 15%. Even HDFC Bank is not there at this level today. Right. So, and just to put it into context, the promoter warrant conversion need not have been done because the bank was roughly trading at 65, roughly around the price at which the promoter warrant conversion was done is a 65% premium to the price at which the bank is trading today. Right. So it need not have been done at all. So there is some level of infusion of capital being done by the promoter to increase their equity stake as well. What do we think in terms of our view? I'll talk about what these numbers mean in the form of providing some context and history. So if you look at the market cap evolution of the bank, right? When I say FY10 to FY19, it went from approximately a 10,000 crore market cap bank to almost a 1 lakh crore market cap bank. And that's where, after which is where COVID hit and things started falling apart. Slightly before that, actually, and it continued into COVID. And now the bank is at a recovery phase. So the business has completely derated in the form of valuation. So what I mean by derating is what used to be price to book of 4.7 is roughly at around 1.3. However, the fundamentals are improving. The NIM margin, which used to be 4.3 and is now back to where it used to be. The balance sheet now has adequate capital even to absorb temporary slowdowns on the book. So what could happen over the next 3 years as the loan book advances pick up? Assume that I get zero re-rating, which means the price to book stays as it is. I still look at 11% return on the stock, which roughly translates to around IRR of 4.5% over the next 2.5 years. However, if the advances growth continues, which is what our expectation is, and even if I get a slight re-rating, the IRR expectation on the upside seems to be significantly high. So what I'm trying to tell you is, with Sumant Katpalia getting a re-extension from RBI, we are betting on the fact that management continuity, what he's transitioned into, and the fact of what that loan book actually has, should see a net loan growth in the mid-teens, which translates into a price to book potentially north of 2, as a result of which a healthy IRR is what we expect. Even if we get this completely wrong, it doesn't look like we can lose a lot of money. And those are the kind of situations that we like. So I just wanted to take you through one of our recent additions as we've ramped up some of the exposures in our portfolio, across all our client portfolios. As we move on, I just thought I'll take some time to cover why did we maintain cash? Why did we speak about having prudence in deployment, and also look at covering why we continue to do that even today. Many people look at this and say, isn't this timing the market in terms of having a view on Nifty, which basically means you say that market is expected to fall. These are two different things. I don't have a view on whether Nifty is going to go up or down in the short term, which is what, when anyone asks the question, what is your view on the market? That's what it effectively means. But I do have an expectation of saying, when I want to get fully ramped up in the portfolio, this is what I need to explain the difference between when you invest in a mutual fund and when you invest in Itus. What is the difference you are taking on? A mutual fund's mandate is to get you invested tomorrow, because their mandate is either large, mid, or small, or multi-cap, however they are structured, to take you into a 90 or 95 or 100% equity exposure tomorrow. My mandate that we have set for Itus since day one is, if I cannot get a base case IRR of high teens IRR, that's what we are targeting, roughly between 18 to 20%, I'm not looking at investing. So what that means is, there are times in our journey that there are good companies which are trading at a significant premium than what I expect them to trade at, as a result of which we will not invest, primarily because the valuations are not in our favor. It's also important to understand the structure of a PMS and the structure of an MF. And if you think about when PMSs are actually sold in the market, you will understand what I mean. The way a mutual fund works is, it is a pooled structure. What that effectively means is, let's say I'm an investor in an MF. So Naveen invests in a mutual fund at a NAV of 10. 1 year later, the NAV drops to 9. Now, Naveen is scared of the market and saying, oh my God, I'm down 10%. I don't want to add capital into the market. Let me wait for this NAV to come back and then I'll think about adding. However, there is another Naveen sitting in Jammu and Kashmir who basically adds money. Because there is new inflow coming from someone completely unrelated from the first Naveen, the first Naveen still benefits, because units are allocated for everyone in the pool structure at a lower NAV. And hence, a mutual fund is an inherently better structure in a bear market. Obviously, there is no perfect world. The same thing that benefits a MF in a bear market hurts it in a bull market. What does that mean? If the same thing I reverse it, and instead of NAV going from 10 to 9, it goes from 10 to 11, additional capital coming in means the MF is buying more units at a higher NAV, which means all the investors are buying more at higher prices, as a result of which their marginal returns going forward starts to reduce. In a PMS, your account is yours. So unless and until you add money specifically to your account when the market is down, you are not going to get the benefit. As a result of which, inherently, A PMS will always beat a MF in a bull market, and a PMS will always do poorly in a bear market. This is given. This is not. This is a structural advantage that no one talks about. Hence, what do we do about it at Itus? And this is the primary reason we do capital calls. What a capital call is telling you is we believe there is an opportunity for you to add. It's not going to be easy because it will come at a time when the market is down or we have underperformed. If it's both, then it is ideally great, but psychologically, it's a hard time to invest. And that is why we communicate a lot more than we need to during bear markets. I wanted to spend some time on this because very few people speak about this. Very few people, I don't even know many people who understand this, but it's important that I address this aspect and why we do capital calls, why we write about them, and how you should think about them, whether you add capital or not. The next stage of what I wanted to cover is I wanted to explain this concept of when I say we are in cash, what do I even mean, right? And now that I have some data points to show you, I thought I'll share that with you. And what do I mean by this, right? So when me and my team on the research side have a set of 250 to 300 companies that fit our criteria at every point of time that we want to invest in, these are our so-called companies that have what we call managements that we know, we've built relationships with, or managements that we trust. They have cash flow growth as an inherent nature. They have return on incremental capital that's expanding, and they have pricing power. And from there is what we narrow down and do channel checks on the ground into our research process. The last aspect of how we think about portfolio construction is valuation. And do we have the valuation comfort? And valuation comfort is not about one price. That's how the industry has made it. No one knows the price of what a business can go into. If they knew, then people would have put all their net worth in Asian Paints 30 years back and sat quiet, right? No one knows. In fact, the promoters themselves don't know. Otherwise, all their net worth will only be in their stock. So what valuation actually means is a range of outcomes. What happens when things can go right, and what happens when things can go wrong? What happens when things can go wrong is a bear case. And what can happen when things can go right wonderfully is a bull case. However, our view of the world is a base case growth estimate. What does a base case mean? Base case means that if our country's GDP grows at around 6.5%, 7%, inflation is 4%, what do our portfolio companies, where they tend to grow at? Is it 12, 13, 14, 15? Depends on the industry dynamics. So at any particular price, there is an IRR that we model in the form of range of outcomes. So we have certain buy limits for each of the stocks that we own. And there is a price that the market offers us on a daily basis. And back in October 22, there was a price at which the market was trading at. So if you had constructed an Itus portfolio back then, the IRR was 14% at the base case. From our buy limit, it's almost 19%. And from the current market price, it is 16%. So effectively, what I'm trying to tell you is over time, as markets move on a daily basis for event risk or micro risk, the IRR changes. And when the IRR becomes into a range which becomes more interesting to us is when we buy. So when we are saying we have cash, it's a function of saying, can we construct a well-rounded equity portfolio with an IRR expectation of north of high teens? And if we can't do that, we will prefer to stay in cash. And this is the exact same thing that we use for selling as well. What does that mean? When the bull case of a particular stock, in the best of scenarios of growth, is roughly in the single digits or low double digits, there is an opportunity cost of holding such businesses. Those are the primary reasons that makes us sell. For example, in Infosys, when we sold the business, even in the best of growth rates that we saw, that we could foresee, the IRR was coming out to 10.5%. And it didn't make sense for us to hold it at that IRR. And that's why we completely exited. So for us, cash is not a function of the market. It's a function of our portfolio, the potential IRR that we can generate in a base case scenario that we can envision. It's really important to understand this. And that is where the qualitative effect of investing comes in. If everything around investing is only math and modeling, then all of which can be programmed, then you don't need any humans. And I don't believe that we'll go towards that day as long as you have investing as your core philosophy. If you have trading as your core philosophy, it's a different proposition altogether. So I wanted to spend some time on this because there have been a lot of questions that we have received saying, what is cash for? Why do you hold cash? Are you timing the market? It's important that I address all of these questions. IT sector earnings. So over the next two slides, right, I'll talk about some sectoral earnings, what we saw, why we were concerned about IT and why we don't own IT at the moment in terms of the services business. So if you look at the three slides that are represented, we've taken the three marquee companies in India, Infosys, TCS, and HCL, for a range of reasons in terms of the kind of clients they have. Obviously, the revenue growth has been reasonable, and they have been able to protect their margins. And the commentary up until the last quarter or this quarter was they are getting increased contracts in the form of vendor consolidation that most of the US companies are going through. What got us uncomfortable was on the back of increased contracts, you hire people, you don't let go of people. But that's what was actually happening on the ground. The net addition start was decelerating in nature, not incremental in nature, and that got us concerned. And that was one of the fundamental reasons we completely exited as well. Right? So it's just not about saying that there is a model and there is a number. It is also backed with certain data that we are seeing on the ground. Against this, why are we bullish auto? So it's important to understand two trends that we are seeing in the country. So obviously, auto data will always be distorted because we are not a China-like market, which has seen 20 years of structural auto growth and consumption. There is cyclicality in our business because auto will and continues to be a discretionary spend. But the interesting thing is, even though we believe we are a two-wheeler market, over the last 5 years, the growth that we have seen has come from the four-wheeler market. And because of the fact that the growth has come from the four-wheeler market, you will see a lot more models and a lot more supply and a lot more competition coming there. As a result of which, you never have pricing power beyond a point, right? As a result of which, when competition comes in, who benefits? The people who have a hold on the ancillary market, who are supplying to you, which means I am not taking a call on whether Mahindra is going to garner market share or Tata Motors is going to garner market share, because they are doing it by cutting prices in many cases in order to sell every time there is a warehousing increase at their inventory level. I'm not interested in that cyclicality. But whoever gains market share, the core suppliers of the components, be it powertrains, be it gears, be it transmission gears, or be it crankshafts, will benefit. As a result of which we like to take exposure in the ancillary business, and that's when we look at our portfolio. Most of our auto exposure will come from the ancillary business. Two-wheelers, though, is still having a structural decline. It's still not picking up significantly. On a year-on-year basis, it's slightly better. And as a result of which you're seeing companies like Bajaj Auto or Eicher Motors, which is slightly more on the premium side, having a year-on-year growth. But if you look at it over a 5-year calendar, there is still some amount of lackluster growth there. So we continue to not own auto OEMs, but we continue to own auto ancillaries, and that's where our exposure will increase as we go forward. So just to recap what we did, we spoke about our performance. We spoke about our latest addition, how we think about capital calls and cash in the portfolio. When do we go into cash and when do we invest and when do we get ourselves fully deployed? And finally, why did we actually cut our IT exposure late last year? And why are we significantly overweight auto ancillaries today? Two more points before I kind of conclude this and open the floor to questions. Many people have asked us, you've been cautious, bearish the US markets. for a while now, will you ever turn the other way? So obviously markets means macro, it doesn't mean micro. So I have to use macro variables in order to get to a certain thought process around why we are cautious. It's important to understand what this equity risk premium means. So in the US, equity risk premium is saying the difference between the S&P yield versus the 10-year bond yield. What does this mean? So assume that S&P of the index, the PE multiple that you give to the index is 20. Okay. The earnings yield is 5%, which is basically 100 divided by 20, which means price divided by the PE multiple is the earnings yield of the equity portfolio. That's what it means. And against that, I have the opportunity cost of going to the fixed income market, which is the 10-year bond yield if I do that. Because S&P, if you go into equities, most people think 10 years. So you compare it with the 10-year bond yield. So what does this chart tell me? Every time the S&P yield goes significantly higher than the bond yield, equities become attractive. So let's say 2008, when the crisis actually hit, look at what happened in this part. The PE dropped significantly, right? As well as interest rates dropped. So you got a crisis, which effectively meant it was a great time to invest in equities, but people panic. So every time there is a spike in S&P minus 10-year yield, it is a great time to invest, but it also means it's a panic. Look at 10 and 11. This was when the Euro crisis and the Greek crisis hit. Look at 2020. It was when the COVID hit. And where we are today is almost 1.4%. What this means is there is only, I'm getting paid 1.4% risk premium additional for investing in equities versus what I can get if I just go and buy 10-year treasuries. And if people are telling me at that premium, and it's never happened in the history of US over the last 12 years, right? So at that premium is where people are now, HNIs in India are taking money in the name of diversification and putting it in the US. And I don't know why, right? So why will I continue to want to invest in US equities when I get my least equity premium for investing in US equities? The concept that is sold as diversification, do I believe in it? Not really, not at when the probability of me losing money becomes extremely high. So just to put it into context, we're not cautious because I feel like being cautious. We're cautious because valuations don't make sense. Macro is not favorable and risk reward is not favorable. Now, the obvious question is, what does this mean for India? And this is not like a foolproof way. Right? It's not like if it goes up, you invest. I'm just using this as a benchmark. Just as people say, okay, I don't know if you follow, but if you look at health, your weight, for example, people say that your height in centimeters minus 100 should be your weight. It doesn't mean that if it is higher than that, you can't be fit. But that's just a simple benchmark. And that's what I'm just using for simplicity's sake. So look at the same thing for India. So the column so look at the line in orange, which gives you the same metric. Here in India, we are slightly unique because our 10-year yield is always much higher than the PE at which the Nifty trades. So if the PE is inherently higher, the equity yield will be lower. So let's assume that your PE of India is Nifty of India is 25. So it's 4%. But 10-year in India doesn't trade below 4%. So that means it'd be negative. So here we have reversed it. We've taken the 10-year yield of fixed income minus the 10-year yield of Nifty or the E by P of Nifty. And here what that means is lower the number, better the risk. So over the last 5 years, if you look at it, this low number is effectively COVID. So while and as it goes high, it basically means valuations are getting expensive. So you need to be slightly cautious. Purely from a so-called the question of saying, where do you think about the market? It has nothing to do with fundamentals of your companies. But when someone asks the question, what do you think about the market? This is a good way to think about the market. Again, it's important to realize just because it is high doesn't mean the market can't go. For example, over the last 1.5 to 2 years, while the market has been up to range bound, your yield differential has not changed much. It has gone between 200 on the lower side all the way to 300 on the higher side, right? So it is a contextual way to think about risk. So what I'm finally saying for people who find this complicated, the simple way that what I'm trying to say is the following. India still has opportunities. It's not expensive, but it's not cheap either. US looks extremely expensive to us, as a result of which I'm cautious. Put another way, this is another way to think about this. The market cap to GDP number. In India, we've oscillated between 75 on the lower side and 120 on the higher side. This looks at it at 94 and basically saying we are in the middle of the range. So it means neither too cheap, not too expensive. What that means is bottom-up opportunities is where you're going to make money. Finally, before I conclude, everyone wants to know the view on inflation. And today we are going into a world where people are looking at CPI numbers on a month-on-month basis and commenting whether the market is going to go up or not. I think it's nonsensical because CPI numbers on a month-on-month basis are backward-looking. So what we are saying and what I have maintained is the following. We are entering a world where inflation is going to be structural according to me. So I don't believe that Fed is going to cut anytime soon, which is kind of the consensus in the market today, that Fed will cut. Why am I saying the Fed will not cut? Most likely is the following. The way the central banks globally have inflated their balance sheets and their debt, the only way out today is by ensuring that you actually inflate your way out of this debt. What that means is manufacturing related capex additions, which is funded by the government balance sheet. This has happened in the past as well. The 70s boom kind of resulted because of that. And I think you are going into a very similar environment over the next few years at a structural level. So what I'm basically saying is what inflation that you are seeing on the ground is structural. Interest rates being high are here to stay, as a result of which a fund manager constructing portfolios has to think about things from a bottom-up perspective and where they want to invest. Where we are investing in terms of portfolio construction is skewed towards manufacturing, capex addition, and auto ancillaries being a theme is also a reflection of the same thing. What should you expect from Itus? Very quickly, this is what you should expect from Itus. You should expect a portfolio which invests in growth, buy at the right valuation. For us, promoter quality and management is integral. We want to be long-term owners of business, and you should expect us to outperform over 3-year cycles when you benchmark us to Nifty. When will we get fully invested? Because everyone asks us this question. When our portfolio IRR can get closer to 20%, you will see us completely invested. So I'm going to stop here and open the floor for questions. Ajit, you can take over, and if you could streamline that, that will be very helpful.
Thank you, Naveen. So, very informative. Participants who have questions can feel free to type in their questions in the Q&A section. The identity of investors are protected as the questions are only available to the panelists. Naveen, I have a question. How do you see the global liquidity affecting the market in the medium term and the long term?
So I think today the way where we are, even the Fed doesn't know what it's going to do next. So if anyone in India thinks that they have a view on global liquidity, I am not sure where that view is even coming from. So I think the Fed has clearly pointed to the fact that they are going to tighten liquidity, but every time they tighten, it results in a mini crisis based on what you saw with the SVB as well. So it's not an easy environment. So the macro is not easy at all. Liquidity is going to tighten, not loosen at this stage. Your equity valuations, at least from a global perspective, is not very attractive. So I think macro is certainly not conducive at all from a global perspective, and that's what I highlighted. The only place where you have some amount of comfort, both from a macro and micro perspective, is India. But macro is uncertain in India, especially because one thing I didn't cover is oil. I think oil prices can go higher from here. Again, it's an anti-consensus view, but that's what I've said for a while now. And macro could worsen in India if oil prices go high. So you have to be bottoms up, you have to be stock picking, and that's where your returns over the next 2 years are going to come from.
Understood, Naveen. Thank you for that. Now I have a question on a particular stock which we hold. So, what would be your view on IEX over the next 4 to 5 quarters?
So over the short term, there are headwinds. Why are there headwinds? Because roughly 3 quarters back, the government said that when you are trading on the exchange, both the buyer and the seller needs to pay a charge, and that should be reversed somewhere around June 2023. That's the expectation. Post that, whether you trade off exchange or on exchange, the price normalization is the same. So there is any anomaly that actually happened in the last 1 year, that's going to get reversed. Second thing, if you look at commentary of many of the small cap companies in India, many of them are not able to manufacture because the power of prices have gone up. And because of the prices of power going up significantly, government has actually said that you can actually import coal for the first time in the last 12 years and open up your manufacturing. So there is a power crisis. Globally, in India, it's slightly better because we have access to coal, but even now we are facing the crux. So net, the government has to use the exchange in order to ensure power availability is there across the country. At higher prices, the volume of the exchange has gone down in the last 1 year. Stability in prices will come if supply goes up, and that's what the government is going towards. So if you ask me short term, there are headwinds. Longer term, it's structural in nature. This is a business that I think will do well because there is no competition. There is a small exchange called HPX, which is not beyond anything in terms of market share. So exchange is a network business, as you can see with NSE and BSE. So I am optimistic on IEX purely from a longer term growth perspective.
Understood. What is your view on hospitals? Can it be hedge against inflation?
I don't know. That's too complicated a question. As a hospitals as a hedge against inflation. I mean, it's unfortunately, I think when you are managing money, you cannot take 20-year views, right? This seems like a 20-year view to take, saying hospitals are a hedge against inflation. We are strong. We are bullish on hospitals. We have been for a while. We own one of the childcare pediatric hospitals in the specialty space. We have owned it for a while. We'll continue to own it. We stopped buying it purely from a valuation perspective. If there is some correction, we'll own it. But to have a generic view on hospitals is a bit complex because they are very cyclical in nature. What that means is every time they have some level of ARPU increase, everyone increases their hospital beds and goes into capex mode, which is what we are seeing today. When everyone adds capex, then utilization needs to ramp up. So hospitals and hotels have very similar dynamic. Today, hotels seem like brilliant businesses. 3 years back, no one used to touch them. So I think one needs to be careful and pay attention to valuations rather than say I'll own any hospital at any price. I wouldn't do that.
Okay, understood, Naveen. Now, how would you? So we've added IndusInd into our portfolio. How would you compare against banks like SBI and HDFC over the long term? And how do you see the long-term growth of this of IndusInd?
So I think the first most important metric for me for evaluating any bank is the management and their track record. Now, effectively, as a bank, why is the management the most important thing for me? Primarily because the management is the one that builds the culture, the ability around who you want to lend to and where you want to lend to, as a result of which becomes a capital allocator. While SBI is and will be the best, the largest systemic bank in the country, I would not invest in SBI, or rather, I have not invested even during COVID, and obviously and now I would not invest purely because it's a PSU, and I don't think they are the best capital allocators on the ground, though their PAT could grow significantly this quarter as well. So HDFC Bank we own, we'll continue to own. I think both from a flow perspective as well as a fundamental perspective, things are looking fairly robust on the ground for HDFC Bank. So If you're asking me for a comparison between IndusInd, SBI, and HDFC, HDFC is a bank that we owned. We continue to buy, not at this valuation, but we used to buy roughly around up until 15% lower, which used to be roughly a price to book of approximately around 2.7. We stopped buying as the company's shares started performing, and we're not buying at this stage. SBI we've never bought. I don't think I will. And IndusInd Bank is purely on the back of management quality, execution, and what I expect from here over the next 2.5 years.
Understood. Thanks, Naveen, for that. Naveen, what would be your view on diagnostics with new players coming in and over the last 1.5 years?
So I think if you look at the history of diagnostics, it's the easiest business for private equity to enter. Primarily because it's been thought of as a business which requires initial capital. After that, it starts generating cash flows. And people think you can scale it on a pan-India basis very easily. But if you then look at the history of diagnostics in India, it's only resulted in regional players. There are only two so-called pan-India players even today. Hospitals are now trying because hospitals have had a good 2-3 year track record of generating cash flows. There is only so much of capex that they can do in the form of beds addition quickly. So many of the large hospitals are now starting diagnostic chains. So that again is slightly more what I call captive in nature for themselves. Now, diagnostics corrected primarily because their base valuation was wrong, because it was given a valuation as an extension of COVID revenues, and that went to zero very quickly, that no one expected. As a result of which the revenues came down as well as valuations corrected significantly. Now, the noise around diagnostics on the negative side is digital players over the last 3 years have caused price erosion for them. Because if you look at diagnostics ARPU, which is average revenue per unit of tests, it's not increased significantly in the last 4 years, primarily because of these new age players trying to do it on the digital way. However, there are noises, and I'm seeing things anecdotally on the ground that many of these new age players are struggling. Some of them on the verge of shutting down, some of them on the verge of trying to sell their diagnostics business. So the pricing pressure that was there is kind of abating. Maybe 1 or 2 quarters, I think you should start seeing normalization of that. So I think if you can get access to a pan-India player who's executing well, and I think a steady growth rate for diagnostics business at a top line, at best case is 13 to 15%. I don't expect it to grow beyond that. That's on the top line, but the cash flow conversion can be much better if it is efficiently run. Right? So 13 to 15% top line can translate into an 18 to 20% on the cash flow growth. So if you can get access to those companies at the right valuation, it becomes interesting. But I think short term, there is some amount of pressure that one must expect from a headwind perspective, but I don't think it will last too long. That's the view that I have today.
What is your view on quick service restaurants over the next over the next year in the short term and the medium term?
So in terms of QSR as a structural theme, it makes a lot of sense. However, it's important again to go micro and bottom up and look at which one has potential to expand and which one has potential to expand predominantly through debt. What that means today is over the next 3 to 4 quarters, because of pricing pressure and the way the QSR industry is going, where they are trying to go into the lower end of the pricing segment, I think margins could come under pressure, as well as the growth rates could be lower than what you're used to between 2012 and 2017. But there are many QSRs in the last 4 years which have been set up, which have been expanding through debt. I think they're going to find it hard. The ones that have the ability to grow through internal accruals should grow stronger. So for example, I will segregate QSR into categories. One, you have the pizza category, where Jubilant is the dominant one, and you have participants like Papa John's, who are coming into India for the second time. They came in, they said India doesn't work, they exited, now they're coming in again. And now Jubilant is slightly diversifying in the chicken category with Popeyes and expanding there. Then you have the likes of KFC, which is doing it through Devyani and Sapphire. Both are KFC, but both have very, very different owners, debt profiles, and management plans. So again, you can look at it as KFC, but internally they are very, very different. Third is you have the smaller players like Burger King and McD's, Westlife, which has existed for a while. And then you have the private equity funded players. To me, QSR across the board should see increased bankruptcies. People should leave the space because there is headwinds. So what that means is that player who has funded through internal accruals and they are expanding through the internal accruals from a longer term perspective should do well. So it's purely bottoms up. We own one out of this and consciously aware that we could have another 3 to 4 quarters of headwinds. And if I see that translating into lower prices, we'll increase exposure there. So that's how I think about it.
Understood. How do you see CE Info Systems, a stock, a specific question?
So the way when we construct portfolios, right, it's important to understand rather than, I need to answer this, and again, it's an important concept to explain. Every business that we own, there are times when once we make up a thesis, we categorize it in the form of how much can we lose depending on the track record, longevity, as well as the tailwinds for the business. There are well-established businesses which have been running for the last 50, 60 years, where the promoter quality is stable and they have a track record of allocating capital over long periods of time and they go through tailwinds. Those are the companies where you see higher exposure, where probability of loss at the right valuation is lower. There are some other companies which are slightly more emerging in nature, where the probability of loss is also higher. What that means is we will curtail that loss through a much lower exposure. For example, for people who are not in the call, let's say 2 quarters back, Nykaa was that example where we exited at a loss, but our exposure was much lower. It was at 2%. That's our starting exposure. CE Info belongs in that category where the start it's at 1.2%. In terms of what we think about the company, as EV picks up, as autonomous picks up, CE Info becomes your default vendor for using maps in your so-called autonomous vehicle. So whatever the two-wheeler market growth had between Bajaj Auto or Hero or any of the South Indian players, all of those were non-EV. Today, a base EV comes with a map installed in it. And that map by default is CE Info. So CE Info will grow in a volume-driven market. In a connected market, because of the pricing power in India, they do not have pricing power. So from a longer-term perspective, it's run by a well-run set of promoters. They've gone through their own troubles because of Google, but there is a runway for growth. However, at the valuations that they are available at, we are not comfortable taking more than a 1% or a starting exposure. That's how we think about the runway for growth, as well as what happens when we get it wrong.
Thank you, Naveen, for that. With inventory levels at a higher level in dealer places, do you think car sales is going to get affected, and in turn the auto ancillaries also getting slowed down?
So it's possible. It's certainly possible that car sales can get affected on a quarterly basis. And that is why auto is inherently cyclical in nature. But at the same time, ancillaries, if they are manufacturing a high engineering component, have better ability to protect their margins. So ancillaries make money on 2 aspects, on volume growth and pricing power. If your ancillary business is predominantly only forging, which is purely a machining and a process-oriented job, you don't have pricing power. If your ancillary business is a crankshaft or a transmission gear or a distribution gear, which has components that have both ICE and EV implications, you can protect your margins through both volume as well as volume expansion in the EV space. So the ancillaries we own are those which just not cater to ICE, but also have a portfolio catering to EV. So yes, there could be some level of dealer expansion, inventory-led slowdown in the auto space, but I don't believe that will immediately translate into the ancillary based on what I just said. It's very, very similar. Think of it this way. Think of what happened to real estate and how did your ceramics company react on the back of that. You'll see a lot better balance sheet at the real estate ancillary level than you'll see at the real estate developer level. It's very, very similar to how you need to think about auto and auto ancillary.
Understood, Naveen. Thank you so much. I have one last question. Now, with banks like SVB and Credit Suisse running into problems, do you see any impact on our portfolios indirectly, or how do you see the impact towards startups?
So, towards startups.
Towards startups.
Okay. So, no. So, I think the so I'm going to use this example based on what happened to. Just look at it. I think the question, whoever asked the question will be answered if you just look at JPM's earnings last night that was reported. It was the highest ever PAT that they ever reported, right? So what happens, this is not a banking crisis. This is just an ALM mismatch. An ALM mismatch is done by poor risk management at the treasury level of a bank. Why does it happen? Because you lend to certain your so-called lenders, but when you collect your deposits, they are short-term in nature. So either you basically lent long-term, collected deposits short-term, which means you have rollover risk, or whatever free float that you have or the treasury reserves you have, you put it in so-called risk-free assets, which got repriced on a mark-to-market basis because interest rates went up drastically in the US and you got killed on the mark-to-market. So I've continued to maintain the following. India is the tightest regulator, be it in terms of asset management, be it in terms of banking, be it in terms of brokerage, or be it in terms of custody. The US regulator is lax. The reason SVB happened is because the regulator was lax. I don't think that risk exists in India from a banking system. And even if it does, it exists at a smaller bank. The regulations that what happened with SVB, in our regulations, I can tell you at 100% confidence, this same risk cannot happen because we have to mark to market. SVB don't have to mark to market because it's not a systemically important bank. And when such a risk happens, look at who benefits. The large bank benefits. And you can verify the same thing based on JPM's earnings last quarter. So no, I don't think it will. That is the risk that should affect the Indian banking system.
Understood, Naveen. Thank you so much for the answers. Over to you, Maggie.
Thank you, Naveen and Ajit, for the presentation and the Q&A session. That was informative. And I'd like to thank you all once again for the patience on the call. The recording of this webinar will be sent out once it's made available. And once again, thank you all. Wishing you all a happy weekend.